afternoon, everyone. I'm Leanne Wilson, Mantex Marketing, Director of Marketing and Business Development. Today's presentation is Pricing in a Crisis and DaVinci Analytics. The presenters are Chris Nigon and Ben Hess of Strategic Resources Incorporated. We are going to use the chat feature for the question and answers, and we will have that opened at the very end for in-person questions. And we are recording today's session. So Chris and Ben, take it away.
Thank you very much. I'd like to thank everybody for participating today. This presentation is an informative exchange of knowledge about pricing theory, pricing strategy, and most importantly, to you manufacturers, pricing tactics. Now that we're coming out of this COVID hiatus, this is a very relevant topic, and I think you'll find that Ben Hess, our presenter, is fully capable of illuminating this subject for you and also answering any question you may have during the presentation or after the presentation as we see fit. But this is a very important topic. Ben comes to SRI from 10 years at Deloitte, working in the pricing practice with two of the seminal minds in pricing theory in B2B business, B2B pricing, and also comes with a MBA from Northwestern, from the Kellogg School, and a lot of experience with SRI, dealing with the kind of problems you deal with every day. And not only dealing with them, but helping solve them. So I will pass the baton on to Ben, and please enjoy the presentation.
Great. So good afternoon, everyone. This is Ben Hess. So what we'll do today is we'll talk a little bit about just best practices that we see and how to think about being more proactive in managing price as an aspect of your business. So we'll go through, just some of the trends we're seeing and how companies are starting to think about pricing, and then get into some case studies that I think will be pretty practical examples of the typical pricing opportunities we commonly see for middle market, lower middle market companies. And then, as we go, you'll hear a lot about how pricing should be a data-driven exercise. So at the end, we'll highlight a little bit of how we're seeing companies take advantage of analytics for pricing or other aspects of their business, as well, with a walkthrough of some DaVinci analytics as an illustration of what that looks like for some companies today. So look forward to engaging in dialogue here. So for those who may not know Strategic Resources, our motivation for our work is primarily wanting to uncover the keys to more profitable growth, and then building analytical tools for leaders to confidently create real value in their business. So this is typical of sort of the broad purview we have and work in a lot of different ways with companies, but it's very relevant to pricing, with the idea being that pricing can support profitable growth and is a strategic area of opportunity for a business. So that's sort of the strategy side of the equation, but it needs to be analytical and should be managed with analytics and data capabilities, which is typical of the approach we take to sort of the general work we do, where it's being data-driven and analytical, and using data and information and analysis as a basis for helping execute. So doing just as much work on the execution side of things. So as we talk about pricing, I always start with this cartoon from Dilbert. So you can see on the left, it's the marketing guru, and he says, consumers will buy our tractor-sized MP3 players if we offer something free with each one. So we'll offer a free iPad with each sale and free towing to the landfill for our MP3 player. The rest is just pricing. So the reason I start with this is because I think it illustrates some of the common shortfalls or shortcomings we see in how companies think about pricing. So the one shortfall is a lot of companies think that price will solve all their problems, and it won't. So in this example, if you have a really bad offer, like a tractor-sized MP3 player that nobody would want, pricing isn't going to solve that. The other shortcoming I think it illustrates is how pricing is oftentimes an afterthought. So we see a lot of owners, leaders, managers that put a lot of thought into how they manage and control other aspects of their business. So in this case, again, sort of the offering of what's on the table. It could be more of the operations side. Could be other aspects of the business. But pricing then is oftentimes sort of an afterthought, and folks don't have as much of a structured or detailed approach to how to think about it. So part of what we want to do today is help sort of talk about best practices that can bring to life how you can better manage price in your business. So if you think about why pricing is important, the real motivator here is a 1% statistic. So if you think about where you'd want to make a 1% improvement in your business, it's generally in price. The reason for that being a 1% gain in price will increase your operating profits by anywhere between 8 and 12%. And that increase is greater than what you would get from a similar 1% change in other aspects of your business. So it's greater than if you reduced your variable cost by 1%, increased your volume by 1%, or reduced your fixed cost by 1%. So pricing really is the biggest bang for your buck in terms of where you want to make an improvement in your business. And there's any other number of motivating statistics to support why pricing is important. So Deloitte, had a study that shows that price initiatives deliver 12.3% return on investment. If you compare that to other ROIs for other performance improvement initiatives, it's typically going to be one of the higher priorities you could set. McKinsey has talked about how effective pricing strategies and tactics can deliver a 2 to 7% increase in return on sales. So again, if you compare that to other efforts and return in terms of return on sales, typically one of the more powerful levers you can pull. KPMG has talked about how poor pricing decisions can leave at least 10% of profit on the table. I'd say in our work with middle market, lower middle market firms, that's probably a minimum number, the 10%. It's not uncommon for us as we get into looking at pricing opportunities in a business to see more than 10% profit improvement from more proactive management pricing practices. And then Warren Buffett, from an investment perspective, has talked about how the single most important decision in evaluating a business is pricing power. And I bring this up because in our work, we do a lot of work with private equity firms. And so, oftentimes when I'm dealing with a privately held or family-run business, you can ask the question, what would private equity do with your business if they owned it? And that's typically, thought starter to try to spur some outside the box thinking. But in our work with private equity firms, pricing is probably one of the biggest areas of interest we're seeing right now, where there's a recognition that to maximize the value of a company, price, because it's the biggest bang for your buck, is a very important lever. And so to the extent private equity is thinking more about pricing, we think a lot of just privately held family-owned businesses should be doing the same, with the same goal of trying to maximize the value of your business. So, so price, there's a lot of reasons to be thinking about price. So what I want to go through now is just some of the trends we've seen of late in best practices and how, the best companies we see are, doing a better job and being more proactive in how they think about managing price in their business. So, historically, I'd say pricing was a sensitive and undermanaged aspect of a business. Undermanaged because being a sensitive subject, it's something people wanted to shy away from. People were reluctant to touch price. There's always the concern, if we raise prices, what's that going to do to volume levels or, customer relationships. And, while it's still generally a sensitive subject, what we see is a lot of companies, for a lot of the reasons I just mentioned, flipping that on its head and actually putting price front and center and recognizing the central role of price management in overall performance improvement of a business. So I think there's a lot of, a lot more conversations we're seeing where price is the going in point and the starting point for opportunity in a business, because, it has been undermanaged for so long. And a lot of companies are saying, now's the time to get better control of pricing. Historically, there was a lack of data and information to inform price management. So pricing, as I said, should inherently be an analytical exercise. That's no longer really an excuse, because what we've seen is just in the last 10, 15, 20 years, companies of all sizes have invested in some sort of basic ERP or IT system that now gives them, in our experience, at least the starting point type of data and information that they need to inform pricing decisions. So, people maybe weren't able to run analytics in the past, but nowadays everybody at least has a starting point for the type of information they need. Cost plus pricing has been a common heuristic and methodology. I wish I could say that was just in the past, but we still see a lot of cost plus pricing. And while it's important to understand cost in thinking about price, it should be a factor in thinking about price. Certainly if we have a variable cost structure that doesn't, our price is less than what our variable costs are, we need to know that, right? So we can't price ignoring cost. But really the best practice and what most companies should be thinking about is value-based pricing. And that's really the name of the game. So think of that as taking more of an outside-in view of pricing to make it more market-driven and value-based. The one thing I would say with regard to cost plus pricing is, with the current crisis we're going through, considering cost as a factor into price, a lot of companies we're talking to were recommending they reevaluate their costing methodology, because the problem with cost plus pricing is, oftentimes it's a point in time type of exercise where companies go through and analyze what their cost basis is that they can, apply a margin on top of to get to their price. And the challenge with that is, when your operations fundamentally change over time, oftentimes those assumptions aren't revisited. And so that cost basis can get out of whack and lead to, over or under costed, and therefore over or under priced products. And where the cost basis typically gets out of whack is when operations change. And in today's environment, whether a business is been positively impacted, right, that volumes might be way up as a result of COVID and its impact on a business, or obviously plenty of companies are seeing volumes way down. Really getting a handle on what is the true cost basis given the change in operations is really important. I'd say in the past, there was a lack of understanding, or at least common knowledge, around pricing theory, or what the practical approaches are to thinking about price. But really, nowadays, a lot of the strategies and tactics around pricing are much more well understood, much more well proven. I always say that if you look at Deloitte, where I was at, or McKinsey, or other firms that have published books on pricing, it's really been in the last 5 to 7 years that a lot of those books have been published. And so, it's taken a little while for folks to kind of turn towards them and pick them up, and some of the thinking to become more well known or well understood. But there's a lot more practical just knowledge out there to give people confidence in how they think about pricing for their business. Pricing is oftentimes perceived as an art or a black box model, right? Which can sort of go into it being a sensitive subject or an undermanaged part of a business. What we see is pricing should be both art and science as a best practice. So the science is data driven to try to bring objectivity to how to look at pricing opportunities. With the recognition that there still is managerial judgment we need to apply on top of analytics. We don't advocate for just algorithm-based price decisions, right? It's a combination of using data and information to be objective and looking at where there's opportunity, but then applying managerial judgment to say, what decisions do we want to make about price. So I think the idea is you get beyond just simple art with the data and information, and that gives people more confidence with an objective fact base about how to think about pricing. And then commonly playbooks, whether it's private equity playbooks, whether it's just day-to-day, the emphasis that leadership or management teams place on managing different aspects of their business. We've seen a lot of emphasis on cost cutting and the operations side of the equation in the past. Certainly in the current environment, that's been an area of emphasis either out of immediate necessity or just taking the opportunity and the current crisis to sort of reevaluate the cost structure of a business. Certainly those are well-placed efforts. But in terms of coming out of this crisis and or just generally when things return or at more of a normal steady state type of environment, commercial value drivers, including price, other things around customer profitability management, sales force effectiveness, mix, share of wallet management, those types of things. The best practice and what we see the best companies doing is they're putting just as much emphasis on those areas of opportunity as anything else, because they can be just as impactful in improving the performance of a business. So those are some of the trends and best practices we're seeing. So let's jump into a couple case studies. So these are all real world situations from the last 24 months. They illustrate common pricing opportunities we see in today's marketplace. And I think as we go, you'll see the type of tactical and actionable, not just theoretical approach that we take to thinking about pricing opportunities. So as we go here, there's some 80-20 exercises we'll describe that can be informative and bring pricing opportunities to life and make them very apparent for a business. And then 3 of the 4 case studies are from work with private equity owned businesses. We select that simply because not every private equity owned business is well run, but in large part they're oftentimes better than average run companies. Otherwise, folks wouldn't be investing in them. And so, we highlight the fact that, to the extent these types of opportunities commonly exist in PE-owned businesses, for a general privately held family-owned business, it's even more so the case that these are likely to be areas of opportunity. And so we have sort of different flavors of examples here relative to, the business model as well. We have some manufacturing examples, but to the extent there are other business models and pricing opportunities that exist there, it's oftentimes we find helpful for folks to hear about what other types of companies or other industries are thinking about, because that can oftentimes spur thoughts for your own manufacturing concern. Okay. All right, so let's get into the first case study. This is an industrial parts manufacturer where the goal was to uncover the next wave of profitable growth opportunities after a private equity firm had come in and purchased the business. So it was a very data-driven management team, but they really lacked some of the basic and key frameworks for thinking about new opportunities relative to profitable growth, particularly thinking about how to leverage price to help with growth opportunities. So we performed a diagnostic that looked at kind of a variety of different areas of opportunity. Pricing, and then in this case, sales management became kind of key areas of focus from the work, and ultimately identified value equivalent to 13 times profit-based return on fees. So that's not, sales return on fees, that's, sales down to the margin and profitability level and an ROI on the investment that was made. And what we find is that's pretty typical of a pricing type of effort. Is I'd say you should expect to see somewhere between 12 and 17 times return on the level of investment if you do it right in terms of identified opportunity. And the opportunity here at this business was really around what we call value-based pricing. So this business had a range of product groups they sold. Some were more on the what I call commodity or less value add side. So think of this as products they might import and just resell, or things that they were selling through a catalog. And then on the other end of the spectrum, there were more solution, more value add types of products. So these were things that required some design component, had custom fabrication, required some custom engineering. More of a solution sell. And so we worked with the head of sales there to just say, let's put your product groups into, each of your product groups into one of these 2 buckets of the commodity versus the more solution value add products. And then we ran a gross margin profile on those two product buckets. And the gross margin, as you can see here, was the same. So that's a problem to begin with, because in general, on a relative basis, you'd expect to see a higher relative return on your more value add solution oriented product groups. So then we said, okay, let's look at your P&L, and they had some significant below the gross margin line cost to serve, their operating expenses. In this case, they had a 7-figure investment in an engineering team and center. So they had a little design center, they had specific engineering resources. And so we worked with that group to say, how is your time, how are your resources, how are they consumed on a day-to-day, based on what you're doing, where are you spending your time relative to these different product groups? And unsurprisingly, as you would expect, they were spending more of their time on the more value-add solution-oriented products. We then looked at their selling expenses, and we asked the salespeople, where are you spending your time? What level of time and effort is putting into selling different product groups, right? And again, unsurprisingly, because it was more of a solution sell, required a more involved and higher investment sales process, those costs and those resources were being spent more on the value add side of the equation. And so you can probably see where this is going, which is, when you factor in not just looking at gross margin, but also look at some below the gross margin line costs and come up with something along the lines of what we call contribution here, they were upside down, right? Where they were actually making a lower contribution percent on the more value add product groups than on the less value add. And so I would say this type of, going through this type of exercise, 80-20 exercise to move costs around, to evaluate these types of relationships and think about where there's, we might be upside down in terms of the ROI we're getting for different parts of a product portfolio is very common, right, in our work. And so obviously the next step here that was to take this forward and dig into that more value add group of products and think about market dynamics, competitor dynamics, and say, where is their opportunity and how do we refine the product groups where we think we can, help correct for this upside down relationship by being more proactive and better managing pricing. So very common area of opportunity that we would see in a manufacturing setting. All right, so let's go to the next case study. This is in the consumer environment. So it's a B2C business, consumer products manufacturer. The goal here was to turn around a struggling business. So this was a private equity owned firm, one of the not so great private equity stories in terms of how the business was performing. The business had hit some operational and market headwinds, in part as a result of raw material price increases, significant raw input increases. That they said, hey, we need to reevaluate price in the context of those changes and think about how we better manage price to turn around the performance of this business. So this company sold both through online channels as well as brick and mortar, the online being their own website as well as selling through platforms like Amazon. So we were asked to help reprice everything that they sell online. And so I'd say this is a particularly relevant exercise because a lot of companies right now, given the current crisis, are migrating or trying to enhance or bolster their digital and e-commerce capabilities. So this type of thinking should be pretty relevant as companies think about doing more of that. And again, here very significant profitability gain. So identified price gains and profit improvement of 1.5% to 3% of sales. So really significant gains identified. And so the opportunity area here came around market-based competitive pricing. So we ran a bunch of analytical tests to sort of come up with recommendations to increase, decrease, or hold price. And I'd note that when we talk about price, we're not always talking about increasing prices, right? Because how easy would it be for me as a pricing consultant to just walk into businesses and just tell them, no, just raise your prices, just raise your prices. That's sometimes what is needed, but is not always the case. So we think about just as much about where there are opportunities to decrease price, or where there's need, I should say, to decrease price that unlocks growth opportunities for a business. And maybe we're constrained in growth or volume levels because we're overpriced. So But one of the analytical views that we ran was this one you see here, and it became a pretty important way to think about opportunity in this business. So this was just looking at a time series view of pricing for our products over time. So the x-axis is just a timeline, and then the line is where our price was over time. And so one of the things that we noticed from the start is that this company had some weird price points, like a $44.99. And I say that's a weird price point because particularly in a consumer setting, consumers do have rules of thumb they apply to say that, they look at a price and they say that's basically $10 or $20 or $50 or $100, right? And I know these things exist as an example because there's a lot of research on this. But when I was at Deloitte, I worked with Carhartt, the workwear apparel company, and they have the winter beanies, right? Like the winter hats that they sell that you see a lot of. And we were asked to reprice that. And so we did a 12,000 person consumer survey and asked 12,000 people, what do you expect to pay for a beanie? And so when I'm giving this type of presentation live, I'll usually ask the group, what do people think? What do people expect to pay for a winter beanie like that? And usually either the first or the second number that's shouted out is $20. And that was exactly what the survey showed. So they spent a lot of time and effort, to ask 12,000 people what they, expect to pay for that. And they probably could have asked just the next random person that walks down the street and gotten the same answer. And so we know these sort of logical price points, I call them, exist. When you combine, knowing that they exist with, in this case, being in a product category around pets and knowing that people will pay anything for their pets, it made it just more apparent that we should be thinking about how to migrate to the logical price points. And so, this became even more interesting because one of the things we saw and were able to do is we were able to scrape the web for competitor pricing, right? And bring that into this view. And we saw a lot of instances in this case where competitors, this took me back to when I was getting my MBA at Kellogg at Northwestern, to Marketing 101 and the sort of most basic pricing strategy that gets discussed, which is sandwich strategy. So what the sandwich strategy is, it says if you're a new entrant into a market, sandwich the main competition, meaning price and offer a product at the high end of the market. It's called skim pricing, capture the highest willingness to pay for customers in the market, and then price at the bottom of the market. So bring in a brand or a product that captures the price sensitive or value oriented customer or consumer, and you sandwich in key competitors. And so in this case, we saw a competitor that it was two different brands from the same competitor that they were doing exactly that. And so this was an evolving product category. And so there was a lot of new entrant activity, and this type of activity played out across a number of the SKUs we were looking at that they were selling online. And the management team had sort of just it didn't have a degree of confidence around, hey, how do we counter this, right? But if you combine the prior page with wanting to get and recognizing that, and knowing that consumers do have these logical price points, with saying, okay, this, that gives us confidence. We can then, have the confidence to counter this competitor price strategy, because otherwise they were just kind of sitting in the middle and afraid to go either outside, the bounds on the high or the low side to counter this strategy. And then the last thing that was, interesting about this is, there's always the question or the concern around leader-follower dynamics. So somebody saying, if I take my price up, nobody else is, my competition won't, and so I'll be exposed and risk my customer relationships, and it's just going to be a bad situation. Well, again, if you organize the data and curate the data, we were able to plot any number of competitors over time and what their price points were, and we were able to see, and again, this was for one SKU, but it played out across a lot of the online portfolio. There were very clear leader-follower dynamics, right, in this industry. So certainly everybody should have been feeling the heat, right, on the raw material price increases. And so it was, really getting this management team comfortable and giving them confidence that if we did move, others would. So in this case, you in making these decisions need to certainly consider sort of broader market or competitor factors. So the client here or the business here, their product category they were in was synonymous with their brand name, kind of like Kleenex. So we were, one of the bigger players. So certainly that played into, having this kind of thinking make sense. But, it's not uncommon that, it's more of just the gut intuition of people say, if I lead, no one will follow. And again, if you bring analytics like this to the conversation, it's oftentimes, that might not be the case, right? The information and the data shows that there are clear relationships, and it's more about, being confident in taking that first step. All right, so that was an example in the consumer setting. So the third example here we have is from a building materials manufacturer distributor. It's a privately held business, very profitable. And the motivation there was ownership wanted to better leverage analytics to improve the performance of their business. So this business had a very diverse customer base, highly autonomous sales organization that led to, in the case of pricing, a lot of price variation. So the opportunity here ended up being putting some improved price targets in place and some basic controls to help minimize margin leakage from poor pricing decisions day to day. And the type of transactional analytics that I'll describe here that became the way to think about opportunity for this business. Going through the type of effort we'll describe, it's not uncommon to see 1 to 3% in identified profit improvement opportunities from sort of basic transactional analytics. And so the opportunity here was around what we call price band analysis. So think of this as looking at on a net realized basis, the price per unit that we were selling at. So seeing the full range of high to low prices that were being realized in the marketplace. And then the height of the bar is the percentage of business that was sold at each of those price points. And so so you would do this by SKU, right? And typically when you put this chart together, it's pretty interesting, to be able to visualize this, right? Where you can start to ask questions as to why, who are the customers on the right, who are the customers on the left, why do these variations exist? And so there's ways to, you can add colors here to highlight different types of customer segments or, things that bring explanatory power. But the idea is, there's usually some, lack of logic in terms of why sort of the full range of prices exist, or there are outliers that shouldn't exist. And so the opportunity, as you would expect, becomes about how do you narrow the price variances. And obviously, you generally want to leave the prices on the right as they are and sort of move the prices on the left up, right? But in theory, the idea is you can put some basic controls, could be some approval processes, could be having established price targets that anchor salespeople on a better starting point for thinking about a price decision, or put process in place, right? Reviews, sort of, regular reporting on pricing and trends around that, establish controls and prices that narrow the range of outcomes and lead to reduced margin leakage from just poor day-to-day pricing decisions where salespeople might be out given discounts and better than average pricing for no good reason, right, to customers. So this type of price band analysis, is very, it's pricing 101. The one thing I would say is sometimes, people ask, well, I'm a distributor, I have thousands of SKUs. How do I even know where to start? I can't do this for thousands of SKUs. And of course you can. So one of the things we've developed is a way to, for every SKU in a portfolio, quantify the value of potential margin lost from this variability in pricing. And so think of it as a bubble chart, like on the right-hand side of the page here, where the size of the bubble is the size of the potential lost margin or lost pricing. And it gives you a very, very visual and very obvious and actionable way to say, okay, let's go after, in this case, the 4 or 5 bubbles that really pop out, and that's where we can go and get the biggest bang for the buck. And certainly sometimes it's larger SKUs, larger volume SKUs that pop up. But oftentimes there's, call it SKUs in the tail that end up being tail type of products that a customer buys. When I say tail products, it's non-core, non-key products that they may buy that they're less price sensitive on, that they might pop up as well. And so those are some very low-hanging fruit in terms of just getting after these types of pricing opportunities. Is focus on parts of your portfolio where there is less price sensitivity because it's just lower total cost of ownership, or just sort of the D type of slow moving SKUs in a business. Okay. And so then let's go through the last case study here. This is from a services business where ownership, the business was growing less than was desired. And so ownership sought ways to reignite sales. As the CEO there said, they wanted to tune the commercial engine before, and it was private equity owned, before the PE firm ultimately exited and sold the business. And so again, here I looked at a number of different areas, price being one of them. Another area that became very important was around sales force or sales team effectiveness. So how could they maximize the performance of their salespeople, and identified initiatives that could yield growth of up to 6% and $5 million of profit improvement, including by leveraging price better. And so the opportunity here is around what I call price architecture. And the idea with price architecture is generally you should be able to take any portfolio of products or services and line it up in some logical manner, left to right, top to bottom, some logical manner. So in this case, this business operated in different geographic markets. And so we were able to say, okay, let's index the sort of priciness, right, or costliness of different markets, right, with third-party data, and but just readily available, publicly available third-party data. And so we lined up the different markets, and then we plotted a dollar price per unit for the services they offered in their different markets. And so in this business, they had kind of two types of product lines. One was more of a premium, that's the green or the dark bubbles. The yellow or the lighter bubbles were more of just commodity or everyday type of services they provided. And what I always say is when you plot these dots, there should be and you draw a line between them, there should be a shape to the curve, right? Depending on the type of business and the nature of the business, it could be a straight line that you'd expect. It could be a curved line, but there should be a shape to the curve. And so what you're looking for is where there's kinks in the curve, right? And that's where there spells opportunity. So in this case, you would have expected there to be more of a straight line relationship to where the price points were at. And so you could see there were kinks in the curve, in those bubbles that needed to migrate to the shaded regions. And what that allowed them to do was to align the price logic across the portfolio, get appropriate price architecture. And so this was something that when we put it in front of the management team, I mean, their eyes sort of popped out of their head and they said, wow, this is very apparent, right? And very, very actionable. We then took these recommendations down to the local geographic markets, and they actually said, what took you so long, right? In terms of getting on board and recognizing there were these types of pricing opportunities. So high level of adoption and big bang for the buck in terms of very quickly acting on this, one, and then two, seeing very significant growth and profit gains from taking these price actions. And so, generally, again, when I think about middle market, lower middle market companies, it's very rare that I walk in and go through this type of exercise, that there's not some sort of a kink in the curve that when you run this type of analysis becomes a very apparent and actionable area of opportunity. Okay, so those are the case studies we have. So I think you can see, take a very practical, actionable approach to how to think about pricing opportunities. Here I just wanted to sort of briefly highlight and flash up just some of the key pricing frameworks that exist. So we talked about a couple of these: price band analysis, price architecture. The key is that there's a lot of very structured ways to think about, for your type of business, for your business model, what's the right framework to use in evaluating and looking for price opportunities. These are the types of things you could or should be familiarizing yourself with. The price waterfall is sort of related to profitability analysis, where it gives you a way to look at, gross to net pricing, or, list price all the way down to, EBITDA, and it gives you an organized way to structure your data for analysis that highlights opportunities. And so there's any number of frameworks, and the key is just choosing the framework that's right for your business and taking a very structured approach to how to think about acting on and actioning on price opportunities in your business. So in terms of, just practical steps for getting started with pricing, the first thing, as you can tell or might have expected, is it's assess and organize your data. So to the extent pricing should inherently be a data-driven exercise, we need to, audit and assess the quality and availability of data and information. Most companies, like I said, have at least the basic stuff they need to get started. Certainly that can be augmented and enhanced, right? Either, through some data efforts, or, if you have better than average quality data, you have even better than average starting points for this information. But need to, organize your data. As I just mentioned, then it's about selecting the right pricing frameworks. Not all pricing frameworks are created equal in terms of the type of business you have. So you really need to make sure you're looking at things the right way, and know what the right things are to look at for your business model, in sort of the right lens through which you're going to look at your data. You then need to go through analytics efforts. So you saw a bunch of those types of analytics today. The key thing as you go through the analytics is you want to get to the insight, right, of the chart with the kink in the curve, or the upside down, profitability relationship. But then you also want to quantify the size of the prize, right? So what's the value of moving those bubbles up where there's the kink in the curve? Or what's the value of going from a 44% to a 51% contribution margin? What we find is that a lot of middle market, lower middle market companies, they're never short of very good ideas, but in terms of setting priorities and being able to act on them, and getting people sort of rallied around, hey, let's move forward and take action on these things, they oftentimes just don't have a good way to prioritize and get people rallied around an idea. So putting the dollars at stake is a very objective way to do that, because typically people will see the size of the prize and say, okay, that makes sense. Let's go do that and get after that. We then, always say, and best practices, you should be leveraging tools for pricing to track and monitor over time. So pricing should not be a set it and forget it exercise. That is, you can get some value in that, but you will end up ending up leaving a lot of value on the table, as time passes. So it's something you really need to proactively manage. And there's plenty of tools out there. You could have sort of a homegrown, just simple Excel spreadsheet that you might use, or there's all the way at the other end of the spectrum, there's very sophisticated pricing software. Usually that's not the best fit for a middle market, lower middle market firm, because you're not going to get a good return on investment of that. But there's any number of ways to think about it. The key is just figure out what's the right tool for you, and be proactive in getting something started and stood up for managing this pricing as part of your business. And then the last piece is to be proactive and shape, evolve, and manage over time. So again, it's not about set it and forget it, or as the pricing gurus that I worked with at Deloitte, the gentleman who literally wrote the book on B2B pricing, always used to say, pricing isn't about one-time home runs. It's about consistently hitting singles and doubles over time. And that's when where and how and when you're going to see the biggest profit improvement and the biggest, increase in the value of your firm from leveraging and better managing price is doing it consistently on a singles and doubles type of basis over time. All right, good. So that was what we had for the pricing piece of the discussion. So what we thought we'd just conclude with before we open the floor for some questions is just an illustration of, as I said, pricing should be an analytical exercise. And so, for pricing as well as for other improvement opportunities in the work we do with companies, I'd say in addition to price, the other area we see the most interest in is around analytics, where companies are saying, in leadership teams are saying, how do we become more data-driven and analytical in how we manage and run our business? And so, what we've done is we've curated a library of the firsthand proven analytics in areas like pricing or customer profitability or sales force effectiveness or other areas of a business that that we've seen be actionable and insightful in our 30 years of working with middle market and lower middle market firms. And so just wanted to highlight that and sort of illustrate how some companies are using the latest and greatest tools and techniques around analytics, because it's powerful stuff. And again, in the current crisis, a lot of companies are saying, hey, maybe I wasn't as data-driven as I should have been up to this point, but I better be data-driven right now because there's a lot of still uncertainty in many, many industries as we look forward to the new normal and the new world we're operating in. And so, people need to be real smart about the decisions they make and the path they chart forward. So, we help companies, set up and think about, accessing things. A lot of tools nowadays, it's just simple username login where you can come in. And then, the key here is how do you think about structuring views of analytics of your business that make sense for the things you want to manage? So these are, in our library that we call DaVinci Analytics, folders, so to speak, of the areas of opportunity we commonly see in our work. So you see pricing, you see, a couple different pricing ones, some mixed share of wallet, some sales force related things, customer profitability. And, companies needing to say, what's our reporting platform and what are the analytics packages we need to manage our business? And, an example of things you can do with these. So I'll click into customer profitability here. While this is coming up, there's this concept called the customer profitability whale curve that folks may have heard of. And the idea there is you want to define a measure of profitability for a customer, not just at the gross margin line, but it's something, of a contribution or an operating profit level. And so imagine your transactional just order data sitting behind this. You can come in and take basic numbers from your P&L that sit below the gross margin line. So your SG&A and warehouse and delivery and other operating expenses. There's a logic here that pushes these dollars over here out to customers that you can then see this is my highest operating profit customer from a dollars perspective, next highest operating dollar, next highest. So you can visualize very quickly customers that increase my profitability, customers that are where the curve is flat or neutral in terms of profitability, and then customers that actually reduce my profitability. And so it's not uncommon when you do this that depending on the type of business you're in, your 100% of your profits could be a function of customers that deliver 300%, positive 300% profitability, and others that reduce your profitability by 200%, a negative 200%. And that's how you get to 100% operating profit, right? And so what you can do is use this whale curve, as it's called, to start profile things. So imagine, coming in saying, I want to have a winner who's anybody that's over $50,000 in profitability. A loser is anybody who's under 1,000. Middlers are somewhere in between. You can then start to profile. What's the gross margin profile of these customers? Cost to serve. How does my operating profitability vary? Here you see $1 million opportunity from negative profitability customers. You can highlight sections of this curve, and for sections of the curve, or click on an individual customer, see their individual performance. And so you can use this to very dynamically start to slice and dice your business and understand what are the insights and what are the opportunities that you can action on. You can then get more tactical, right? So the whale curve is kind of the key chart. You can then start to say, okay, let's put things more into a 2x2, put some sort of organization, right, to how we look at and group and manage customers. You have some customers that, you can then start to define, hey, these are the ones we want to grow with, either maintain good growth levels or grow faster, right? Others, or maybe the bottom left type of customers that they're not good. Some of them we might want to fire. Others we may have upside down order economics that we need to put some minimum order quantities in place or other sort of practices. And then others, maybe it's more of a commercial thing where they're just cherry picking our product. And so we need to optimize the mix of what we're selling, or maybe our pricing isn't as good. Others, it's maybe they're just really costly to serve. They exhibit bad behaviors. They place a lot of really small orders. It sort of creates noise and cost in our business. So you can start to sort of take the whale curve, start to move things around and organize customers into cohorts that become the basis of action and opportunity, all the way down to, imagine looking at this on a customer level, where you come in, you choose an individual customer, and, in this case, you see it's an unprofitable customer. The mix of what they're buying appears to be okay, but it looks like they're getting a better than average or better than they should type of price. And then they also have some bad order behaviors. So being able to get very, very granular and tactical and actionable. Imagine a salesperson bringing this up and thinking about for their key accounts, sort of what's the basis of opportunity for what we can do better to improve that customer relationship and therefore improve the performance of the business overall. So there's different layers to the analytics, but it's going from insight all the way down to action and execution. And so the DaVinci analytics that we offer and sort of the best practices, we just encourage every business to think about these, leveraging these types of tools, whether it's for pricing or other parts of your business, like customer profitability, to think about how do you be more data-driven and analytical. And so that was what we had. So I think at this point, I'll pause and we can open up the floor for some questions.
Sorry. Please comment on how pricing strategy relates to differentiating your product from your competitors' products. Isn't it innovation a critical aspect of pricing?
Short answer is
yes. In the
yes.
chat if you want to see it.
Yeah, the short answer is yes. It's a great point. So if you think about the components of your price relative to competition, there's basically two components. One is a reference price. So regardless of, every business has competition, or every product or service has a next best alternative, that if a customer is not buying from you, who are they buying from, right? And if anybody says, I don't have any competition, I'd say, well, you at least have the competition if people could just buy nothing, right? And so everybody has a competition. So the two components you should be thinking about are, what's that reference price? What's my competition at? And then the other piece of pricing is differential value. So the idea is, if we're priced higher than our market or competition, that's because we should have some positive differential value, positive differentiation that we should be able to justify our price against. Sometimes companies are priced lower than competition or market, and that's because they have negative differential value, right? So absolutely understanding, basically understanding your value proposition, your competitive advantage, your basis of differentiation helps you think through, sort of what is the reference product or service and what's that reference price, but also says, do we have positive or differential value in our business, and can that be justified in the marketplace? So yes, that's an important part of that. Pricing does not exist in a vacuum. Like I said, it's not just an algorithm type of exercise. It's sort of you need to take a broader lens to pricing, profitability, and profitability pretty clearly relates to where we have differentiation and competitive advantage. I always say, when I was at Deloitte, there was a reason they called their pricing practice the pricing and profitability management practice, right? Because these things go hand in hand. So great question and good point.
We have another one. For manufacturers, is there a model that works best to account for strategic pricing opportunities based capacity / utilization of resources?
Yeah, that's a great point. So what I would say is, and this goes back to the costing piece, is absolutely, and we see a sort of a gap or a disconnect very commonly between sort of commercial thinking and decisions in a business and operations. where an understanding of capacity and utilization, and how that influences the profitability picture of different products. If you're not accounting for capacity versus practical capacity and doing your costing appropriately, you can have very skewed pictures of the profitability of your business that could, you might think you're doing really well and making really big margins in one area, and you're not, and you might be overpriced or underpriced in certain parts of your business. So the short answer is, you need to think about, with pricing decisions, through your costing, being able to get your costing right to get to accurate profitability pictures of the business. And that costing should reflect, how to think about capacity, practical capacity utilization, and account for those things in your portfolio. And that, yes, oftentimes that creates a kink in the curve, or creates an upside down relationship, that when you get the costing and profitability right, it leads to pricing based opportunities.
How do I break out of a price rut? All competitors are underpriced and fear to make a move to rectify it. Value-based analysis?
So yes. So, the example, and I know it might be in a B2B setting where it's different than the consumer products company we talked about here, where maybe there's not as much visibility into competitor pricing. But I would say, the idea is trying to wrap your head around and as best you can bring either hard data or insights from your salespeople, because oftentimes they know what's going on, they know what competitors are doing, they see or hear quotes, customers share information with them, but it's trying to understand what your competitors are doing, and exactly that, taking more of an outside-in value-based view to pricing. I mean, there are certainly industries where somebody out of the gate makes a poor pricing decision in sort of a new product category, and everybody gets anchored around that, and it becomes sort of a challenge to overcome. The example we walked through today of the consumer products company in the pet space was partly an example of that. And so if you take a similar approach to that, and if you don't have, like I said, in the consumer setting, visibility into pricing for competitors, you can probably get some insights from your salespeople, and taking a similar approach. But and then it's being willing to manage risk appropriately, and step out and take some price actions, and seeing how the market responds, and being able to, and again, not just set it and forget it, but evolve and manage and course correct over time as need be.
All right, that was all of our questions. If there was any others, you can ask right now. Okay, so with that, thank you, Ben, for leading us through this interesting presentation. Our next webinar is scheduled for July 22nd at 11 o'clock. It's part of our Manufacturing Matters series, working on business intelligence, and that will be presented by 425 Consulting Group. We have also on our website have a blended training opportunity for our Six Sigma Yellow and Green Belt training. So our follow-up email will include links to those, as well as a COVID-19 questionnaire that could lead to access to some manufacturing services that we're offering. And it will also include this recording. So thank you all for joining us, and have a great afternoon.
Thanks, everybody.
Thanks, everyone.
Yep. Stay safe.